Frankfurt, Germany, AP, due to out-of-control natural gas and power prices brought on by Russia's war in Ukraine, inflation in the 19 nations that used the euro currency reached a new high. Economic growth also slowed, largely as a result of those rising costs stifling Europeans' ability to spend, ahead of what many worry is an impending recession. According to a study released on Monday by Eurostat, annual inflation hit 10.7% in October. That is higher than the 9.9% in September and is the highest level recorded since the eurozone started keeping statistics in 1997. While liquid gas was successful in filling Europe's winter storage, several industrial items, like steel and fertilizer, are now either too expensive to produce or are just not profitable. As more money is spent on paying for fuel and electricity bills and as necessities like food grow more expensive, consumers' ability to spend money in stores and elsewhere has decreased. Natural gas prices have lately decreased but are still high on the market for the upcoming months, signaling that expensive energy may be a lingering drag on the economy. According to a study of expert predictions conducted by the European Central Bank last week, projections for inflation in 2019 have increased from 3.6% to 5.8%. According to Eurostat data, prices for food, alcohol, and cigarettes have increasingly joined energy prices as important contributors, rising 13.1%. While energy prices skyrocketed 41.9% from the previous year. The biggest economies in the Union had inflation rates ranging from 7.1% in France to 16.8% in the Netherlands, but the three Baltic nations, Estonia, Latvia, and Lithuania, had the highest rates at 22.4%, 21.8%, and 22% respectively. After recovering from the COVID-19 epidemic, the GDP expanded by 0.2% from July to September, slowing from 0.8% in the second quarter. Higher costs, according to economists, are a significant contributing factor, and many believe the economy will contract throughout the course of the rest of this year and the first half of next. But there's no reason to celebrate, he added. The GDP figures, along with a number of other measures, demonstrate that the economy lost momentum throughout the summer. It is an issue of how deep the recession will be and not if there will be one, noted economists at Oxford Economics in response to more recent data showing weakness. The economy and financial markets have seen a series of shocks as a result of higher inflation. With consecutive three-quarter-point rises at its meetings on October 27 and September 8, it has caused the European Central Bank to raise interest rates at the quickest rate in its history. As a result, market borrowing costs for businesses and governments have increased, raising worries that the fight against inflation may harm GDP. High-debt eurozone nations like Italy continue to be concerned about rising government bond market expenses.